Number 3, last sentence first, in its December 31st income statement, what amount should UTA report as basic earnings per share? Basic. UTA Co. had the following capital structure during X2 and X3. Preferred stock, $10 par, 4% cumulative, 25,000 shares issued and outstanding for $250,000. Common stock, $5 par, 200,000 shares issued and outstanding. Okay. UTA reported net income of $500,000 for the year ended December 31st. UTA paid no preferred dividends during X2 and paid $16,000 preferred during X3. In its December 31st income statement, what amount should UTA report as basic earnings per share? Okay, so what's tricky here? What's tricky here is we have preferred stock. So we know that for basic, net income minus preferred. Boom. What do you know about preferred? What we know about preferred is the following. Let me just clean this up so we can see what's going on and read what I've written. All right. What we know about preferred is net income minus preferred. The preferred, if they're cumulative, whether declared or not. For how many years? 1 year only. If they're non-cumulative, only if declared. These are cumulative. So we've got $10. 250,000 shares is 250,000. 4% of 250,000. 10% of 250 is 25. Half of 25 is 12.5. That's 5%. So 4% is 10,000. So our dividend should be 10,000 for preferred. That's how much this should be. Preferred dividends, 10,000. Okay. Now, net income is 500,000. But here's the trick. Because it says they did not pay them. UTA paid no dividends during the year. And they paid $16,000 in X3. They want to know in X3 how much should we deduct, and we had income in X3 of 500,000. Well, here's the problem. So shares, weighted average shares, it looks like the denominator is 200,000. But what goes up here? Because we've got 500, we've got 16,000, we've got 20,000, we've got 0. So it could be 5 minus 10, 500 minus 16, 500 minus 20, 500 minus 0. Which one is it? Well, what are the rules? We paid 16. So 5 minus 16, okay, but wait a sec. When we paid 16, what does that mean? The first 10 goes to last year. The next, oh wait, or do I also deduct just 6,000? Maybe 6,000. Because when I declared a dividend of 16, 10 of it goes for last year because it's cumulative, and then 6 goes to this year. Oh, okay, so it must be 500 minus 6 divided by 2, right? No, because what do? We assume that 10 will eventually get paid, right? Is it cumulative? Yes. What do the rules say? If it's cumulative, you take out all 10 whether they're declared or not. Why? Because they're cumulative. Eventually you're going to owe it. If you ever declare a dividend, it goes back, you're going to owe that. So what that means is we're going to take 10 out for last year. This year we're going to take out 10 regardless of what we pay. Let's say we paid 16. 10 goes for last year, 6 goes for this year. We still owe 4. So next year when we declare $100,000, we're going to pay 4 for this year and 10 for next, and so on. The point being that I want you to see that it really affects only how much you're supposed to pay. So because of that, what is happening is we are going to pay 16, but we're going to deduct 10. So what is that? 500 minus 10 is 490. Divided by 200 gives us something like $2.45. Does everybody see that? Mm-hmm. Nod at the computer. Mm-hmm. Kiss the screen. Mwah. Got it. Let me do it again. They declared a dividend. Oh, I'm sorry, they didn't declare a dividend, but it's cumulative. So we're going to owe 10 and 10 and 10 and 10 and so on. Last year, we didn't pay it, but we should have at least known that we document the fact, disclose the fact that we owe 10 eventually. It's not a liability yet because it hasn't been declared. Once it's declared, it becomes a liability. This year we paid 16. So the 10 goes to the cumulative, the 6 goes towards this year, but for earnings per share purposes, we're going to take out as if we paid all 10 because eventually it's going to get paid. From next year's income, we're going to pay money, let's say, 4 of it's going to go to this year. So what is it? Consistency, 10,000. Answer is B. Number 4, the if converted method of computing earnings per share data assumes conversion of convertible securities as of when. Now, what is the if converted method? It's right here. If converted deals with convertible bonds, convertible preferred, what does it say? It says if convertible bonds or convertible preferred were converted, we add it back in the numerator, dividends, gross, not net of tax, bonds, net of tax, in the denominator, number of shares converted into. You do it as of what? As of the beginning of the year, or at time of issuance if later. A, beginning of the earliest period, or at time of issuance if later, true. Number 5. In determining earnings per share, interest expense net of tax on convertible debt that is dilutive should be what? Well, if it is interest expense net of tax that is dilutive, what are we going to do? Let's see. We're going to add it back here, net of tax, and then in the denominator, you add in the number of shares converted into. A, it's added back to the weighted average shares. No, we're adding in the dollar amount, the money. Added back to net income for diluted. Yes. How? Net of tax, which they didn't say. Deducted? No. Deducted from? No. It's added back to the dollars. All right, answer B.